My name is Adrian Navarre. I'm the CEO and founder of Ticker Trends, and I want to give a quick, brief background for those who aren't familiar. Ticker Trends is a financial alternative data business that I founded, and you might be thinking that's kind of a weird thing for a young guy to get into, especially someone with no finance experience. But I'd say for myself, I was very much self taught in a lot of the things that I do in terms of finance experience, software engineering, business experience. These are all things that I always have found the best way to learn about them and to get most involved in them is to either do your own projects or just go out and kind of break things and see what's out there and learn by doing. And I've done that my whole life, and it's paid me dividends in terms of learning experience and things that I've been able to do, just because I think people who kind of know too much about something, sometimes that can stop them from taking the risks or trying to innovate in that industry. And when you can come into it with a completely blank slate about what to work on, or start working in the industry with a blank slate and then realize different problems and approaches that other people might not have thought of before, I think it gives you a big advantage to working in that industry. So with financial alternative data, for my business, that was a similar approach. When I first got into alt data and applying social arb and different data sources to financial markets, I was really looking for the right way to apply my thesis and my ideas to financial markets. And ultimately, what my thesis was, and still remains to this day, is that I think financial markets they don't understand and don't take into account the potential of social data. And when I say social data, that's things like what we call consumer intent data, which is anything like consumers researching something, talking about something, anything that happens before someone like goes to the store and buys a product or goes online and orders that service or product or brand, all the things that they do before that and the value of that data. Now, what I've learned being in this industry now for a year and a half, which to me is a long time, but sounds like nothing compared to some people, is that I think my thesis has been validated in terms of there being a gap in the market for this type of data and this type of information. The thing about that, though, is that there's always a reason for everything. And for us, we've realized that reason and understood that reason more and more over time as we've approached this business through various different methods. So I'll give a little bit of even more in-depth background into different things that we've tried at Ticker Trends and what we learned from it, and also what we realized. So first, I'll start with the origin of Ticker Trends. Ticker Trends came as a personal software for myself. So when I first started developing the idea of this software and tracking this consumer intent data and using it for financial markets, I was pretty much purely doing it as a side project and something that I would use for my personal portfolio to basically say, well, I want to find what businesses, products are doing well in terms of social purchase intent. And I'm just going to use that to find businesses to invest in myself and use this idea of social arbitrage, which is kind of the more discretionary version of what I do now and what we do at Ticker Trends. But I was just creating this software for tracking the data for myself. Because when I looked out there in terms of what existed, nothing existed like what I wanted, especially at the price range that I wanted as well. So at first we started Ticker Trends with that in mind, where I had someone reach out to me who was essentially liked what I was creating and said, like, I would make the exact same thing if I could. So I want to help you turn this into a larger business. And I started pursuing that, and I learned a lot of things from trying to bring that product to market. And I think it's one thing when you take something that is built for like a personal use case and try to turn that into a consumer product. You learn a lot about things in terms of usability. Something that might be intuitive for you is not intuitive for other people. And we've had to learn that many, many times, bringing this type of technology and idea to financial markets, which is not everyone understands or is willing to want to understand the value in something unless you literally like smack them in the face with the value. And I mean, that sounds obvious in hindsight, but I think it's difficult to understand the extent to which you need to get to for it to be valuable to the right person. So with Ticker Trends, when I brought this product to market, it was something that, to be honest, was not developed in a way or structured in a way where it would be successful and in a open to the public. The reason being, it was too confusing, it was very difficult to use, and it was difficult to find those end actionable insights, which ultimately is what people care about the most. So over the past year and a half, we've evolved that use case in so many ways, whether it's improving the base platform for research and manual discretionary use, and then also really focusing on what I mentioned before, which is allowing people to have conclusions from the data. But we also learned a lot of other things, and I guess that's also what I wanted to share as well, were some of the experiences that we had in trying to scale and grow Ticker Trends early on, and what we learned from those things. The two first things I want to start with is one, the consumer market or lower cost market, and then two is the quant market. So these are two polar opposite potential customer bases, and these are two customer bases that to some extent we either still work with or have worked with in the past with the Ticker Trends business. So first, I'll start with the retail investor or consumer, lower cost potential customer for like financial products. I think when you're a retail investor, or even myself, when I was trying to look for a software like this for my personal use case, when I first started building Ticker Trends, I really felt that, why would no one make this for the average retail investor? Because it seems like something that would be so obviously valuable to so many people. What you start to realize when you start to get into the retail investor market is that the retail investor market is growing. However, the certain niches within the retail investment market are still, relatively speaking, pretty small. So when it came to users that would understand alternative data or value alternative data or have similar ideas about incorporating alternative data into their research, the overlap between low-cost retail customers and understanding or wanting to use alternative data is, to be quite honest, is just a smaller group of people. And so the issue with that market is that just due to the size of the market in its current state, and it's a mixture of the current state of the market, but also how the information is communicated to those users, because potentially if you just said, hey, you should buy Apple stock because the web traffic is doing well, then probably the average retail investor would like that. However, getting to a very scalable business through the lens of using like kind of professional or complex alternative data and translating that for a retail investor base is almost equivalent to making it valuable for professional customers and B2B customers, which basically means that in the current way that the alternative data market is structured, it's actually heavily biased towards professional customers, because the products that a professional or retail customer would want would be applicable for professional or retail customers. And ultimately, the professional customers in finance is a larger total addressable market. So I think that's something that we learned very early on, which is in terms of building like this niche of professional retail investors is very small. And it's a market that, at least currently in finance, is very biased towards basically eventually getting to the point where you're just selling to professional or enterprise customers. So that's the first thing I wanted to touch on. And I'm not saying that retail investment data businesses are not something that can succeed. I think when you look at things like Quiver Quantitative, or Koifin or Ticker, some of these like low-cost financial data terminals, these are a trading view. These are things that have done very, very well. And the reason being is that they're providing things that are necessary to investors, which is like financial data, financial statements, revenue, analyst estimates, like basic financial information, which essentially any investor would need. And so those products can succeed because people need them. But when you start to go to a retail investment product that people don't necessarily need, like the average retail investor doesn't need to understand how the alternative data is performing for a certain business, then it can be a very hard value proposition to sell for a larger customer base that's not just a niche market. Anyways, that's my rant on the retail investment user base of something like a professional data product. Then I wanted to talk about the quant space in the financial alternative data space. So another thing that I think, and I've talked to other founders of financial data businesses. Also, now we've worked with many large funds. So we've worked with both, like let's say the largest multi-strat quant funds, all the way to small to mid-sized quant funds. And we've seen the process of what goes into incorporating a new data set into their process, and onboarding process of how that works. Typically, the structure, just to give a general rundown, is like complex compliance process, testing and trial process, and through that there are many questions, iterations, things that can happen in those in-between states. But ultimately, if you have a data set and you're trying to bring it to market to quant funds, then the onboarding process, at least for the average large-scale multi-strat, could take months. On the very low end, it would take months. I've even heard some founders of large data businesses saying that it took them even longer, like over a year to onboard into certain quant funds. But I think what's really interesting about that is, at least from my experience, I think that the large size quant funds have kind of cut themselves off from certain data sets that they could be utilizing. I'm not saying it's not for a good reason. I also think that when you're a large scale quant fund, like the reason why they're going to be willing to pay so much for a data set, and the reason why they have such a strict compliance process is because even with those blocks in place, they can still be very, very successful. And so there's no reason for them to take kind of additional risk, or essentially they might have already done that calculation and said like, hey, even if we miss out on these additional 30 or 40% of data sets, if we're just getting like the very, very top level, the ones with the most history, the most reliability, the most coverage, then like we can just still cut off the rest of the 40% that we can't access, and that still makes us the most profitable that we can be. And I think they have reached that point, and that's why they have like this onboarding process that takes months and months. But the interesting thing about the quant data industry is that we realized as an early stage business two things. One, that if you want to sell data to quant funds, then in my opinion, as an early stage business, that needs to be your entire focus. Like if you want to be a quant data provider for large scale, long short equity quant funds, that needs to be one of your primary focuses, just because there is such a large process and so many requirements around that process that you virtually can never just take something that is for a different use case. So let's say, for example, at Ticker Trends, we have some data sets which we use for like visualization on our platform. And we try to take that data set and just say, hey, well, you can, you're a quant fund, you can just take that time series data and put it into your quant models. But it's basically never that simple. And that's why I say that if you are an early stage business and you want to get into selling data to quant funds, then I think that you have to set out from the beginning, both in terms of how you're building your data sets, how you're structuring your data, different things about the requirements of that data and compliance processes. And there are many different nuances and requirements that you need to think of for that data from the very, very beginning. And if you're able to do that and you structure your business around being a quant fund data provider, then you can do that well, and there will be demand for your product, almost no question. You can get meetings with any of the largest multi-strat quant funds, and they will want to buy your data or at least try it out. But you have to be okay with structuring your entire business around that, and also having very long lead times, which have almost no certainty in terms of revenue. So the risk about working with a quant fund as well is that you can work with a quant fund for 4 months, doing a lot of work in terms of trying to onboard a certain data set with them. And they could essentially show up one day and say, hey, we're not interested in that data set, or we don't want to move forward with this. And so at that point, as any data provider, you have to be okay with essentially saying, okay, we put 4 months of work into this for the potential payoff of a certain contract value that you would have gotten at the end. But no quant fund will pay you for like evaluating your data, or for the work that you're doing to enter into an agreement with them. So as an early stage business, it's extremely risky because you don't know if you're going to close a certain deal with a quant fund. And then also just the amount of time that it takes, where it can range anywhere from, let's say, 4 to 6 months all the way up to a year or even longer. That's also something where if you're trying to scale a smaller size business, you likely need to realize some form of revenue faster than that, unless you structure your business from the very beginning as being a data provider for quant funds. So I wanted to start with that because I think those are two really interesting lessons, and two like potential customer bases for a financial data company, and things that we've learned from trying to work with those different customer bases. And I'm not saying that I'm right or know everything about either of those. I think some people might have a different experience selling to quant funds, especially if they have a data set that's very specifically good for that market. Then I would expect that maybe, if you really convince them you have a great data set, if you've done everything ahead of time in terms of preparing it, and trying to like slim down that compliance and onboarding process, and they're able to like pick up on the value of it super quickly, then all of those things might be much faster, and less risky for you as a quant data provider. And on the flip side, for retail investment customers, I think there are also ways to structure a product that can be extremely successful for that market as well. So there's no reason to say that you shouldn't still try to approach those markets as a financial data startup. Now, finally, the last market, which we've learned a lot about, which I think has been really interesting, has been the professional and enterprise customer base, especially on the discretionary side of these hedge funds. So what's cool or interesting about this customer base is initially we kind of thought, hey, if we make a really good product for ingesting this raw alternative data, and try to structure that into a professional product, so like better data sources, better tools for visualization, connecting it more to financial markets, then we'll be able to sell that to professional customers, because why wouldn't they want to have all these data sets and all this information in an actionable way delivered to them? What we started to realize with that is actually the discretionary hedge fund market also has its own quirks in terms of what type of data they want to ingest as well. And something that we've realized for all these potential customers is you never want to be a product that is not something that they think they need to have. So when you're something that a potential customer doesn't need to have in financial markets, then it's always going to be a very hard sell to them in terms of like a potential price range that might make business viability sense, if that makes sense. So what I'm trying to say is, like, to a quant fund, your data set has to be really good. If not, they're not going to pay you enough for it to make sense that you can only have like 5 customers, right? If I'm doing quant data sets, I want to sell to 5 customers, I would be hoping I'm having 6-figure or larger contracts with each of those customers, and that my data set is really good. And in a similar way, so they need to see your data set as something that they need and not something that's just a nice to have. And the same thing can be said about enterprise or professional customers on the discretionary side of hedge funds, which is they need to think that what you're offering is something that they need to have. If not, they would be at a disadvantage compared to other investors in the market. So that's why when you see things like AlphaSense, or I guess Bloomberg Terminal would be a little bit different because they're at a state where they just aggregate so much information from so many different sources and different pieces of information to a point where they've gotten into that category of have to have, because there are so many long tail data sources and pieces of information that they've now aggregated into their platform, where they've gotten to the scale where many of the things that people in the past might have had to go to individual providers for are now just more and more consistently always going to the Bloomberg terminal. So it becomes something that people need to have. But when you look at a product like AlphaSense, the thing is, just raw earnings transcripts are not something that people need to have because they can get that from any source. But what makes AlphaSense something that people need to have is once they start doing certain things like expert interviews, or anything that's like exclusive textual information to their platform, where they can then go to analysts and say, hey, well, if you had access to our library of expert interviews and transcripts with people that are giving you information that you wouldn't be able to essentially derive anywhere else, and it directly relates to the performance of these public businesses, now that becomes something that an analyst needs to have, because if not, their competitors might be looking at those expert interviews and ingesting them into their investment decisions, and that gives them an edge over the people who are not ingesting that information. So the way to become something that is a have to have for the professional or discretionary investment community is you have to be something that can essentially move financial markets. So your information and your data needs to be something that when you release that information, it's not inside information. It's not something that's like illegally obtained, but it has to be something that you can say with a certain level of confidence or accuracy that is different from the rest of the market, and is able to, if you have a track record of essentially saying similar things but in an accurate manner, then when you say those things in the future, then it's going to start to move the market. And examples of this are M-Science and Yipit, where they can come out and say, hey, Etsy revenue is starting to turn around in terms of going from negative year-over-year growth to positive year-over-year growth. And that's the first time it's happened in the past 3 years. So now, even before Etsy comes out and says, reports their quarterly results, when M-Science and Yipit start to track the revenue growth to be flipping positive, and they start announcing that, that's going to move the price of Etsy. And now when analysts look into why did the price of Etsy go up today, because they didn't have any quarterly report, they didn't have a CEO interview, they didn't have AlphaSense didn't release a new expert interview, what caused the price to go up? And then they research that and they see, okay, M-Science and Yipit released their numbers, and now it's starting to move positive because analysts are starting to revise their estimates, and expect the growth of that business to turn around. So whenever you're a financial alternative data provider to discretionary analysts, you need to be providing information in a way that can move markets, because then it essentially becomes something where the analysts no longer just something that would be nice to have. Like, it would be nice if we could track the performance of Instagram account for this brand. But if I can say, well, instead of just tracking the performance of this Instagram account for this brand, I know the economic impact of the Instagram performance for this brand. So an example would be, if Garmin gains 500 Instagram followers, then that's worth, I'm just making this up, an additional 100 million in revenue for next quarter. When you start doing things like that, you translate different pieces of information into an actionable insight for the market, and you can move the market because of your accuracy. Then you become something that analysts and discretionary funds need to have. So I would say from all the different customer bases and all the different things we've done at Ticker Trends, those have been some of the outcomes about what we've learned from these different customer types. And so, as you might expect, I guess the transition, or the reason I've explained this, is that Ticker Trends has now started doing KPI predictions. And that was a very long-winded way of saying why we're doing KPI predictions, which is quant market is not so great. Retail investment market, at least with how we've structured our product, not so incredible for this type of data just because it's such a small niche. But the niche that is really good are discretionary funds who need information that can move the market or can indicate real economic performance for these companies. And the way to do that is KPI predictions, which, as long as we demonstrate accuracy and reliability around those KPI predictions, then it becomes a piece of information that analysts need to have and is not just something that's nice to have. Yeah, I guess I hope that was helpful in some random different ways for people out there. I just thought that this is probably a piece of content that is so niche to only people who work in this industry that I don't think it would be shared very publicly, just because there's probably a smaller group of people that would care about this. But I think that there can always be more people in the financial alternative data space. It's so niche that like once you start to get into this industry, there are only so many players, there are only so many people who try to do things in this space or innovate. So it's kind of unique where you're in this intersection of like software engineering, data, and finance, which on its own, all of those things are very like desirable, but in a combination, there just aren't many people that specialize or care about it to that extent. And I think it's because you need to be kind of knowledgeable about all those three different areas on its own, and then combine those skills together and still have the desire to not just like go to a quant fund and make some massive salary. So yeah, I hope this was interesting, and feel free to leave any questions or even feedback about maybe things that you've learned or things that you think was wrong about what I explained in this video. And I'm going to continue to make kind of business updates and learnings videos like this. And then, of course, I'll also probably make a full video on what the Ticker Trends KPI predictions are as well, because it's a product that I've been really proud of that we've been able to create so far. Anyways, thank you all so much for watching, and I'll see you in the next one.